This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Wall Street rallies. Stocks recover almost half of their losses from the recent sell-off. But questions remain about the health of this bull market.
Mounting debt, the White House proposes a nearly $4.5 trillion budget that calls for more spending and widens the deficit.
The big fix? Can $200 billion be turned into $1.5 trillion to improve the country's infrastructure? Those stories and more tonight on Nightly Business Report for Monday, February 12th.
Good evening, everyone, and welcome. Stocks soared to start the week, staging a powerful comeback following the worst week for equities in 2 years. The rally today was broad, with 11 of the 12 sectors in the S&P 500 higher on the day, and it came even as Treasury yields moved back towards four-year highs. The Dow Jones Industrial Average advanced 410 points to 24,601, capping its strongest two-day surge since mid-2015. The Nasdaq added 107, and the S&P 500 was up 36. Now, the gains follow a heavy bout of selling that dominated Wall Street over the past 2 weeks, and there are still a lot of questions about the health of the Wall Street bull. Mike Santoli picks it up from there.
One of the sharpest market drops in years has stirred up a new debate on Wall Street. Is this simply a needed pullback for stocks, or a sign that the bull market might end before its 9th birthday next month? In falling more than 10% over less than 2 weeks as of last week's low point, the major indexes suffered the fastest double-digit decline from a record high in 80 years. While jarring, the swiftness of the move actually supports the idea that this is likely a painful correction rather than the start of a more prolonged bear market that would send stocks down 20% or more. Typically, a bear market doesn't begin so suddenly from a point of broad strength, but develops over the course of months as the market slows down, is supported by fewer and fewer stocks, and sees a buildup in volatility. The fact that economic signals outside of stocks have remained subdued is another hint that a bear market has not begun. Corporate earnings forecasts, leading economic indicators, and credit conditions have held up well since equities peaked in late January. Bear markets outside of recessions have happened in the past, but not too often. This makes the market weakness look more like a quick adjustment in an expensive, high-momentum stock market to somewhat higher interest rates and rising inflation expectations. How long such an adjustment might take and where it might take stock prices is hard to tell. Some traders took heart in last week's strong rebound, which had some features of a pretty good short-term base for stocks. Still, corrections tend to play out over a longer period than just a few weeks, and often they revisit their lows to check whether long-term investors will step in to buy at those depressed prices. At this point, the key indexes have simply slid back to levels first reached after Thanksgiving and are nearly flat for 2018. Taken together, the weight of the evidence suggests for now that this bull market is not broken, but just bent. For Nightly Business Report, I'm Mike Santoli.
Joining us to talk more about what might be in store for this market is Michael Farr. He is CEO and founder of Farr, Miller & Washington. Good to see you, Michael.
Thank you, Sue. Nice to see you.
Let's start with where Mike left off. Is the bull market broken or just bent, in your opinion?
Well, it's certainly bent for now, and I don't have a sense that it's broken, though. This has the stuff that could get us there. Certainly the volatility that we've seen, right? The algorithms that have had these really sharp swings. But I think what we're seeing, is this really change of menu for stocks. We have been feasting on low interest rates for years. Now the Fed is changing rates, and we're now finding our nourishment from Capitol Hill, from tax cuts, and from a whole lot more spending. So it makes sense that this change of diet would be rough for stocks. It could get, I think, probably a little bit rougher still. This volatility today, upside volatility, 400 points, nobody minds upside volatility. It's downside volatility, and breaking that 200-day moving average on last Friday, means that we'll probably go back and test it, and we've still got some red ink in our future.
How does Jerome Powell, the new Fed chief, thread this needle?
He's got a very tough job, Tyler. And, Jay Powell's a very thoughtful guy. I think he has to stick to his guns. I think he can't flinch because, previously, over the past number of years, when stocks would go down, some Fed governor would step up and say, oh, well, the Fed will be there, or we're going to ease rates, or we're going to do something. The Fed has reversed their position, so he needs to stand firm in here, and I expect a rate hike at the next meeting. If we have 3 rate hikes this year or 4 rate hikes, that takes mortgages over 5%. So I think we really have a lot that we need to focus on, particularly on the interest rate side of the picture.
Are you doing some buying in here on these wild market days where we're down dramatically, Michael?
Not a lot, no. We tend to get, as far as we're concerned, the time to really get your house in order is before the hurricane hits. So we had most everything we wanted in place where we wanted it. I have a shopping list, and I certainly have a couple of names I'd like to pick up on a little more weakness. I think we're going to have time.
So what are the next numbers, economic numbers, that you're going to have your eye on to tell you which way this tide turns?
Well, I think, the biggest is going to be what the Fed does if they continue to hike rates. I think, as we were talking, Tyler, you and I, with Ron and Sana, he said pretty much we've seen the market pull back every time that 10-year Treasury's gotten to 290. So I think that's another good bellwether. This week coming up, I think you've got to be watching CNBC and the Nightly Business Report for the CPI data. Is the consumer seeing any inflation? Are we going to see that begin to creep in? That comes out Wednesday.
Michael, it's not very often that we have rising, especially recently, that we have rising rates, but also increasing stimulus and in a big fashion. How does that typically play out, or is there a typical play out for that scenario?
I'm not sure. Yeah, Sue, I don't know that we have this playbook exactly. Interest rates going up and then throwing more gasoline kind of on the fire from the fiscal side of the house, and tax cuts and spending programs. So it's going to be tough, I think, to keep inflation in a bottle. And I know that a lot of people aren't looking for it, but I really can't see with this much debt how we get around inflation. I think we have to start seeing it. The real key for me is that we do begin to see earnings go up and some continued wage inflation, so the average American worker has some more money in their pockets to spend. American workers, middle class, haven't seen wage inflation much since 1997. It's important we have a healthy consumer if the GDP is 2/3 based on that consumer.
Michael Farr, thank you so much, Michael. Michael
Thank you, guys.
Farr, Miller, and Washington.
Well, in Washington, the Trump administration proposed a $4.4 trillion budget for fiscal year 2019. The spending blueprint would widen the federal deficit and would not balance the budget over the next decade. Ilan Mui has more on the White House's fiscal priorities.
The White House calling for big spending cuts down the road as part of the budget proposal released today. The plan would reduce deficits by roughly $3 trillion over the next decade, and just over half of that money, $1.8 trillion, comes from changes to entitlement programs, Medicare and Medicaid, Social Security disability insurance, and food stamps. The rest comes from cutting funding for discretionary programs by 2% a year across the board, effectively rolling back that massive spending deal that Congress just passed after it expires at the end of 2019.
At the same time, the budget reduces the deficit by over $3 trillion. This budget not only funds the president's priorities, but puts the country on a path to restoring fiscal discipline.
The president's budget is not a binding document, but a vision statement of the administration's priorities. There's $18 billion over 2 years to build the border wall, $17 billion to fight the opioid epidemic, and even a paid parental leave program. The White House says its policies will juice economic growth to about 3% over the next decade, and that the 10-year Treasury yield will top out at 3.7%. Already, Democrats are slamming this proposal. Bernie Sanders, the ranking member of the Senate Budget Committee, called it, quote, morally bankrupt and a transfer of wealth from the middle class to the 1%. Meanwhile, fiscal hawks are worried that this budget doesn't go far enough. The deficit would still be $363 billion in 2028, and that means even with big spending cuts and rosy growth forecasts, this budget still doesn't balance. For Nightly Business Report, I'm Ilan Mui in Washington.
The White House is also turning its attention to infrastructure. Today, the president outlined a proposal to fix the nation's bridges, roads, and rails. That blueprint targets $1.5 trillion in investment, much of that coming from the private sector and cash-strapped state and local governments. Kayla Tausche has the details.
With tax reform and a bipartisan budget deal behind him, President Trump moved on Monday to his next priority, infrastructure.
To me, this is a very, very sexy subject. The media doesn't find it sexy. I find it sexy because I was always a builder. I always knew how to build on time, on budget.
The president discussing the plan with 24 governors and mayors on Monday at the White House.
The states will have to do it themselves if we don't do it. But I would like to help the states out, and we're doing that with a very big investment.
The proposal calls for $200 billion in federal contributions. Already, it faces diverging views in Congress over how to pay for it. Democrats think the government should shoulder more than a 14% share of the bill.
Trump infrastructure plan relies on private parties or state and localities to put up the lion's share of the money. In turn, those entities would either have to charge local taxpayers new tolls or raise taxes and other fees to pay for the new infrastructure.
Meanwhile, Republicans, wary of increasing the deficit further, want less.
I'm about $200 billion or less. I actually think, again, the vast majority of this is going to be coming from the private sector if we reform our permitting system that can ensure investors that costs will go down.
Environmental groups worry streamlining the permitting process will mean steamrolling environmental regulations. Business groups support the bill, and according to one estimate, private equity firms are sitting on $70 billion in unspent funds just for infrastructure. But one key stakeholder is on the fence. White House officials say President Trump questions whether the private sector is a productive partner. Citing his time as a developer, his complaint is, all you do is end up in court. For Nightly Business Report, I'm Kayla Tausche in Washington.
Meanwhile, infrastructure ETFs rose after the president unveiled his plan, though the gains did lag the broader market because of questions about that program's financing.
OPEC says demand for oil will grow faster than expected this year, but it also sees supplies surging, driven by an increase in U.S. production. American drillers began pumping more than 10 million barrels of crude oil daily in November. That's more than Saudi Arabia, which is OPEC's top producer. The price of crude sits below $60 a barrel and is off more than 7% over the past week. But gas prices, they're higher. They're up 7 cents on average to $2.65 for a gallon of regular gas.
Time to take a look at tonight's upgrades and downgrades. Cisco's rating raised to buy from neutral at Instinet. The firm expects Cisco to report higher than expected profit this year. The company reports quarterly results on Wednesday. The analysts there raised the price target to $46 a share from $33. Meantime, shares of Cisco rose 2.7% to $40.60. General Electric saw its price target cut at J.P. Morgan to $14 a share. The firm cites challenges to GE's businesses and continued underperformance. The analyst reiterated his underweight rating on the stock, which he has had since May of 2016. Shares of GE fell nearly 1% to $14.82.
VF Corp was upgraded to buy at Stifel. The analyst cites improving trends, rising consumer sentiment, and expects that company to report solid quarterly results later this week. The price target raised to $91 a share. The stock gained more than 1.5% to $80.70. Lumber Liquidators saw its rating cut to neutral from outperform at Wedbush. The firm cites slowing sales growth and increased margin pressures. The price target was cut by 30% to $28 a share. Shares of Lumber Liquidators fell nearly 9% to $24.49.
Coming up, new proposals to lower drug prices, but will they work? The drug maker Purdue Pharma will stop marketing its prescription painkiller to doctors. The painkiller OxyContin is at the center, of course, of the opioid crisis. The company is cutting its sales staff in half, leaving about 200 representatives in the U.S. who will no longer visit doctors to discuss and pitch opioid products. The decision to stop marketing the drug comes amid a number of lawsuits that blame the company for contributing to the opioid epidemic.
The president has complained many times about sky-high drug prices, and in his budget proposal released today, he offers some specifics on how to get those costs down. Meg Terrell has more.
The price of prescription drugs was a popular campaign issue.
If you get prescriptions for medicines that really help you, it doesn't do you any good if you can't afford to fill them.
Stand up to the greed of the pharmaceutical industry.
They're getting away with murder. Pharma.
And President Trump has embraced it since he was elected, saying in his State of the Union address that the injustice of high drug prices would be a top priority for his administration this year.
And prices will come down substantially. Watch.
Until now, though, Trump's plans have been short on details. But in his 2019 budget request, some specifics, mainly involving changes to the way Medicare and Medicaid, the government insurance programs, pay for drugs. The plan seeks to encourage use of less expensive generic medicines, including through eliminating out-of-pocket expenses for generic drugs for low-income Medicare beneficiaries. It also aims to eliminate incentives for doctors to use higher-priced drugs under Medicare Part B, which covers medicines administered in the doctor's office. Where the plan stops short is recommending that Medicare get the ability to negotiate prices directly with drug makers. That's something Trump seemed to endorse on the campaign trail, but which his new health secretary, Alex Azar, hasn't supported. That would align Azar, a former executive at drug maker Eli Lilly, more with Republicans on the issue. Healthcare investors fear direct Medicare negotiation would impose price controls, knocking stock prices of pharmaceutical companies. Because that's not included in Trump's plan, and because many of these proposals would need to go through Congress to take effect, analysts said the budget plan is unlikely to have a major negative impact on drug companies or on the rising prices of drugs. So unless both parties in Congress also take action, lowering drug costs may remain a campaign promise. For Nightly Business Report, I'm Meg Terrell.
So will Washington be able to do something about the high cost of prescription drugs? Here to talk about that is Jeffrey Porges. He's Director of Therapeutics and Senior Biotech Analyst at Leerink Partners. Jeffrey, welcome. Good to have you here. You heard Meg Terrell's report, I presume, that ended on a rather down note of frustration at whether Washington will be able to come to any agreement on ways to lower drug prices. Are you as bleak as she sounded, or are you more optimistic?
It depends on one's perspective, but certainly investors are going to be quite relieved about what's come out of Washington. We've had three major documents come out in the last 3 days or so. We had the budget last Friday for 2018. We had a Council of Economic Advisors report that came out also on Friday with similar recommendations. Then we had the budget proposal for 2019 that came out today. And there are some consistent themes coming through which the drug industry is going to be fairly relieved about. You know, there's a real recognition of the value of innovation, at the same time a recognition of the burden of that innovation on consumers, and there's certainly discussion of some ways to relieve that burden, but there's not really anything that's terribly concrete in the future proposal that would alarm investors in drug stocks, which is probably why we're seeing a little bit of relief there today.
Jeffrey, do you think that the ultimate solution comes from the government through legislation, through changing laws, or does it come from the private sector? I'm thinking of that unique group of Bezos, Gates, and Buffett, who announced a couple weeks ago that they're going to get together and use technology to try and lower prices. Which one do you think will win out, private sector versus government?
Well, certainly the policy of this administration is very much to favor the private sector initiative. And it's probably 18 months since we've heard serious discussion of overt regulation, federal government regulation of drug prices. And the truth is, we're seeing change. We're seeing manufacturers take slower price increases. We're seeing more manufacturers launch products at competitive prices that undercut the existing products in the category. Those are very encouraging signs, and that's coming through the private sector. And the FDA is in some ways acting as an agent of the administration in this respect by approving new drugs faster that encourage competition and bring prices down. So the market is actually applying a fair amount of discipline to drug manufacturers. And if that trend continues, what's probably a 1% to 2% rate of growth in drug spend in the U.S. could even become flat to negative in the next couple of years.
Are these companies doing this because because they fear government regulation, or they fear that the government will green light the ability of Medicare to negotiate prices?
There's a certain amount of not wanting to provoke the tiger in the actions of the industry, but with such a large and fragmented industry, there are always going to be individual companies that break ranks and take excessive price increases, and they tend to attract all the attention. But for the really huge products, the $10, $15, $20 billion products, those price increases are slowing because of competition. They're not slowing because of fear about regulation.
All right, Jeffrey, thank you very much for your analysis. We appreciate it. Jeffrey Porges with Leerink Partners.
Thank you for having me.
General Dynamics beefs up its IT business in a nearly $7 billion deal. That's where we begin tonight's market focus. The defense contractor said it was buying government contractor CSRA for just under $7 billion as it looks to grow its information technology business. General Dynamics said that deal will allow it to provide more cost-effective services to the various government agencies it serves. Shares of General Dynamics were off 1% to $209.53. CSRA soared 31% to $40.39. Broadcom has lined up $100 billion in debt financing to pay for its hostile takeover bid for Qualcomm. That ratchets up the pressure on Qualcomm's board ahead of a meeting between the companies this week. Broadcom CEO called his offer for Qualcomm compelling.
Are Qualcomm shareholders better off today than they were 4 years ago? Answer, no. They're 11% poorer. Ask the same of Broadcom shareholders. They are 500% richer. We are very good at building sustainable businesses and employment and innovation on businesses we acquire.
Shares of Qualcomm rose about 2.5% to $65.66. Broadcom was up nearly 4% to $244.40. And apparently people were eating up those value meals and new menu items at Burger King. The parent company Restaurant Brands reported higher sales. The company reported better than expected earnings and more than doubled its quarterly dividend to 45 cents a share. The shares rose 6% to $59.95.
It just got a little more expensive to visit Disney's theme parks. The media giant said it will raise ticket prices for its parks in Florida and California during peak times. A family of 4 with 2 children can now expect to pay just under $530 for a single day of activities. Now, Disney said the price hikes are meant to spread out the number of visitors it sees throughout the year and not have them concentrated at the peak. Disney shares rose 30 cents to $103.39. Ulta is the subject of a class action lawsuit. The lawsuit alleges the company sold used cosmetics and sold them alongside never opened merchandise. Ulta has responded, saying the health and safety of its customers top priority, and it plans to vigorously defend itself against the allegations. Ulta shares were off 4% to $209.48 in today's trade. And the railroad operator CSX raised its quarterly dividend 10% to 22 cents a share. The company also lifted its share buyback program to $5 billion. CSX shares finished up 4% at $53.16.
Coming up, how a 5% mortgage rate could roil the housing market.
Amazon is reportedly laying off hundreds. As first reported by the Seattle Times, the cuts are focused on its Seattle headquarters and are meant to reduce layers of management there. The layoffs will allow resources to be shifted to fast-growing businesses. Amazon says this is all part of its annual planning process.
One of the world's biggest advertisers is threatening to pull its money from online platforms. Unilever is calling on companies like Facebook and Google to do more to combat the spread of hate and divisive content. The company says it will only invest in responsible platforms that are committed to creating a positive impact on society. Unilever, which owns brands like Dove and Lipton, as well as Ben & Jerry's, has an annual marketing budget of about $9.5 billion.
Well, the housing market may be in for another surprise. Prospective homebuyers are already dealing with a low number of homes for sale. Now, mortgage rates are rising, and some say they could hit 5% in the not-so-distant future. Diana Olick has more.
Mortgage rates are now at their highest level in 4 years and poised to move even higher. They loosely follow the yield on the 10-year Treasury, which is up again today. The timing couldn't be worse. The spring market really jump-started early this year because of strong competition for a record low supply of homes for sale. The average rate on the popular 30-year fixed is now right around 4.5%, still low historically, but buyers over the past 6 years have gotten more used to rates in the 3% range. Mortgage rates have not been at 5% since 2011. A 5% rate would cause more than a quarter of today's home buyers to slow their plans, according to a Redfin survey of 4,000 consumers at the end of last year. Just 6% said they would drop their plans to buy altogether. About 1/5 of consumers said 5% rates would cause them to move with more urgency to purchase a home, fearing rates would rise even further. Another 1/5 said they would consider more affordable areas or just buy a smaller home. Rates have been very volatile, so they could drop again, but the trajectory for the year is definitely higher. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about what a 5% mortgage rate could do to the housing market, head to our website, nbr.com.
Well, before we go, here's a look at the rally that's starting this week out on Wall Street. The Dow advanced 410 points to 24,601, capping its strongest two-day surge since mid-2015. The Nasdaq added 107. S&P 500 was up 36. And on that note, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you back here tomorrow night.